Welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called the Fibonacci Impulse Overextension Fade. This is a counter-move approach designed for fast, volatile trends. It reads a sharp, parabolic run as a sequence of swings, projects a Fibonacci extension to estimate where that run is likely to become exhausted, and then looks to fade the final spike back toward its anchor. By the end of this video, you'll understand how it maps swings, how it uses the average true range to filter noise, and exactly how it decides when to place a trade. Let's dive in. Let's start with the big picture. The Fibonacci Impulse Overextension Fade is a mean reversion style expert advisor. Rather than chasing a trend, it waits for a trend to overextend and then looks to trade the snapback. It's built with volatile instruments in mind, such as gold, index CFDs, or crypto on lower time frames. But the code itself is timeframe agnostic and simply runs on whatever primary timeframe the backtest selects. Here's the core idea. The strategy reads a parabolic run as three distinct legs. First, a measured impulse from point A to point B. Second, a shallow pullback from B to point C. And third, an accelerating extension leg that pushes from C onward to a projected point D. The strategy anchors a Fibonacci extension to that primary impulse, the A to B move, and projects it from the pullback pivot C. With the extension ratio set to the classic golden value of 1.618, point D becomes a statistical estimate of where the spike is likely to run out of steam. Two indicators do the heavy lifting. The first is a symmetric fractal pivot detector, feeding a zigzag filter so that the swings A, B, and C strictly alternate between highs and lows. The second is the average true range, which measures recent volatility. The strategy only considers an impulse worth fading when it is larger than a configurable number of ATR units, so it ignores small, quiet moves and focuses on genuinely stretched ones. So who is this style of approach suited for, from an educational standpoint? It's oriented toward traders who are studying reversion and exhaustion concepts, and who are comfortable with the idea that fading a strong move carries meaningful risk. Remember, this is a counter-trend method by design. The strategy trades one position at a time, uses an ATR-based stop placed beyond the spike, and sets a structure-based target. Everything here is for educational purposes only, and it is not financial advice. Now let's walk through the exact logic, step by step. On every completed bar, the strategy scans for a symmetric fractal pivot, meaning a bar that is a local high or low with a set number of bars on each side, controlled by the pivot strength input. Those confirmed pivots are fed through a zigzag filter. Same type pivots collapse to the more extreme value, and alternating pivots are appended, so the strategy always holds a clean sequence of swings that alternate high, low, high, low. From that sequence, it takes the last three pivots and labels them A, the oldest, then B, then C, the newest. It then measures the impulse, which is the absolute distance from A to B. Here's the first filter. That impulse must be larger than the impulse ATR multiple times the current average true range. If the move isn't volatile enough, the strategy stands aside. Next, it checks the shape. For an up pattern, A is a low, B is a higher high, and C is a higher low sitting between them. For a down pattern, A is a high, B is a lower low, and C is a lower high. When the shape is valid, the strategy projects point D. For the up pattern, D sits above the impulse high, at C plus the extension ratio times the impulse. For the down pattern, D sits below the impulse low, at C minus the extension ratio times the impulse. Now the entry. On the up pattern, the strategy waits for a bar whose high pierces above D, but which then closes back below D and closes bearish, meaning momentum failed at the extension. When that happens, it places a sell. On the down pattern, it waits for a bar whose low pierces below D, closes back above D, and closes bullish, and then it places a buy. In both cases, there's a timing filter. The spike must arrive within the extension window number of bars after C, and each anchored setup is only ever traded once. Risk management is symmetric. The stop is placed beyond the spike by StopAtrMult multiple times ATR. The take profit is a Fibonacci retrace back toward the C anchor, sized by the TP retrace ratio. And once price travels break-even ATR units in favor, the stop is pulled to the entry price to protect the position. Let's read through the code you see on screen, just as it appears in MetaEditor. At the top are the input parameters. Pivot strength sets how many bars sit on each side of a fractal. Extension ratio is the Fibonacci overextension value, defaulting to 1.618. ImpulseAtrMultiple sets how large a move must be to qualify. ATR period, StopAtrMultiple, TP retrace ratio, extension window, break-even ATR, and lots round out the settings. Now the two signal blocks. In the sell block, the strategy computes point D above the market, as C price plus the extension ratio times the impulse. It then checks three conditions on the just closed bar. The bar's high reached or exceeded D, the close came back below D, and the bar closed bearish. When all three hold, and the target sits below the current bid while the stop sits above it, the trade.sell call places the order. The stop is set beyond the spike by StopAtrMultiple times ATR, and the take profit is a retrace back toward the C anchor. The buy block mirrors this exactly. Point D is projected below the market, as C price minus the extension ratio times the impulse. The strategy checks that the bar's low pierced below D, that the close recovered above D, and that the bar closed bullish. If the target is above the ask and the stop below it, the trade.buy call places the order, with the stop beyond the spike low and the target a retrace towards C. Symmetric logic, opposite directions. Let's bring this to life on the chart, walking through both a long fade and a short fade in sequence. Watch the candles form from left to right. In the first few bars, the market rolls over from a local high and begins to sell off. That decline is our impulse leg, the A to B move, and notice that it's a decisive, one-directional drop, exactly the kind of volatile move the average true range filter is looking for. The strategy only pays attention when this impulse is larger than the impulse multiple times ATR, which by default is 2 times. After that drop, price bounces slightly and forms a lower high. That's our pullback pivot C, the shallow recovery before the trend tries to push lower again. From this anchor, the strategy projects the Fibonacci extension downward, and you can see it drawn as the lower dashed line on the chart. That level is the golden 1.618 extension of the impulse, and it represents the strategy's estimate of where the down spike becomes exhausted. Now watch the extension leg. Price accelerates lower, and on the 6th candle it pierces below that lower extension line, poking through it to a fresh low. But here's the key. Instead of closing below the line, the bar snaps back and closes bullish, right back above the extension. Momentum failed at the projected exhaustion point. That's the exact condition the strategy waits for, and the long fade entry marker appears. The stop is placed just below the spike low, sized by the ATR, and the take profit is set as a retrace back toward the C anchor, using the 0.618 retrace ratio. Follow price forward. Over the next 2 candles it snaps back upward, and the market travels up to the take profit marker near the anchor. That's the long trade complete, capturing the snapback after the overextension. Now the same logic plays out in the opposite direction. That recovery becomes a new impulse leg to the upside, pushing to a fresh high, then pulling back to form a higher low, our new C anchor. From there the strategy projects the extension upward, shown as the upper dashed line. As price makes its final push, the 12th candle spikes above that upper extension line to a new high, but then closes back below it and closes bearish. Momentum stalled again at the projected exhaustion point, so the short fade entry marker appears. The stop sits just above the spike high, and the target is a retrace back toward the anchor. On the final candle, price rolls over and slides down to the short take profit marker. Both trades share the same underlying idea. Wait for a stretched move to pierce its Fibonacci extension, wait for that spike to fail and close back inside, and then fade the exhaustion, aiming for the snapback toward the anchor. The stop always sits beyond the spike, so the reward-to-risk profile is defined by structure rather than guesswork. And of course, not every spike snaps back. Sometimes the trend simply continues, and that's when the ATR stop does its job. This is why the strategy risks only one position at a time and pulls its stop to break even once a move goes in favor. So that's the Fibonacci Impulse Overextension Fade. We covered how it reads a parabolic run as 3 legs, how it uses fractal pivots and a zigzag to map the swings, and how it projects a Fibonacci 1.618 extension to estimate the exhaustion point. We walked through both the long and short entry conditions, the ATR-based stop, the structure-based target, and the break-even logic, and we saw it all illustrated candle by candle on the chart. Remember that fading a strong move is a counter-trend approach, and trading always involves risk, including the risk of loss. Everything in this video is educational information only, and it is not financial advice or a recommendation. If you found this helpful, please like the video, subscribe for more MT5 strategy breakdowns, and leave a comment with the strategy you'd like us to analyze next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.